Hey everyone, welcome back to another episode. In this video, we'll be presenting one of our advanced entry strategies developed using smart money techniques. We refer to this trading setup as the fair value gap. In fair value gap, we'll delve deep into smart money concepts. Here's what we'll cover today. We'll guide you step by step on fully implementing this trading setup on any chart, including all mechanical rules to be followed. If understanding smart money concepts, strategies, entry rationales, and maintaining discipline with the trading plan interests you, please hit the like button to show your support and subscribe to our channel if you're new. We'll see you after the intro. But first, a disclaimer. There are two important points about this trading setup. Everything discussed in this video applies to currency trading, stock trading, and crypto because price action remains consistent across different markets. Secondly, ensure you fully comprehend all the steps explained for this trading setup before beginning to backtest or trade it on the chart, as this trading plan is a systematic method considering multiple trading concepts. What is the fair value gap? Essentially, it refers to the space between the wicks of 3 consecutive candles on a price chart, irrespective of the candle's color. In a bullish scenario, when the upper wick of the first candle does not overlap with the lower wick of the third candle, we mark this area as the FBG. What does this signify in terms of price action? It indicates a buy-side imbalance where buying pressure significantly outweighs selling pressure, possibly due to institutional activities. Now, the market has entered an inefficient phase, usually leading it to return to the fair value gap area to address the imbalance. The buy-side imbalance equals sell-side inefficiency, and the sell-side imbalance equals buy-side inefficiency. If you're a smart money trader, identifying the fair value gap should be one of your initial actions when opening the trading chart, with your eyes focusing directly on it. But why do we need to identify fair value gap areas on the chart? They indicate that significant players have participated in the market and impacted prices. The market typically returns to these spots to fill any remaining orders, potentially offering a trading opportunity, but only if orders are still available. Here on the Euro-Dollar 1-hour chart, we observe a bearish trend. The latest impulsive move started somewhere around here and continued downwards. We experienced a sell-side imbalance, signified by large candles leaving fair value gap areas behind. Now, with the price being buy-side inefficient, it needs to return to the fair value gap areas to address them, potentially offering another trading opportunity. We observe a sharp move to the downside, creating a fair value gap area. Then, the price pulls back to this area, rejects the FVG, and continues downwards. This concept applies to all time frames. Even on daily or weekly time frames, we see price creating FVG areas. Here on the Euro-Dollar daily time frame, we have a gap area between the lowest and highest prices traded during a day, created due to massive selling pressure and downside price action. Hence, we expect the price to eventually trade back up into that gap zone, demonstrating the nature of the fair value gap. Now, if you're a day trader, you'll notice that this daily area provides a broad zone for trading opportunities. This is where refining the fair value gap area becomes crucial. Refining involves scaling down to a shorter time frame to identify the FVG within that specific zone. For example, zooming into a time frame one level lower, such as the 4-hour chart, reveals a fair value gap area. Although the FVG area remains the same, We identify a zone where the daily and 4-hour fbgs overlap, making it a powerful area for short entries. This refining method isn't limited to fair value gaps, it can be applied to refine order blocks, supply and demand areas, etc. Major news events in the forex market and other price charts can cause sudden and significant price changes, creating fair value gaps. Traders should exercise caution during such events, securing profits to limit potential losses and being mindful of slippage where prices may change more than expected. It's also wise for traders to stay informed about upcoming economic news and adhere to a risk management plan to reduce risks associated with fair value gaps caused by news releases. If you're curious about how we stay updated on financial news and fundamental analysis, we rely on Fast, a top trading website offering various useful tools, including one of the most accurate and detailed economic calendars. We use this tool daily before starting our technical analysis. 24/7 economic live streaming keeps us informed about the latest trading world's news and fundamental analysis. If you want to benefit from multiple trading tools significantly improving your trading, check the link in the description. Now, on to the next important topic, selecting which fair value gap to trade. Here, we mark fair value gap areas on the chart. The idea is to wait for the price to enter these zones and look for buying opportunities. However, we're only interested in these two areas. Why aren't we interested in the first zone? The reason is, considering the start and end of the latest impulsive move and applying the retracement tool, these two areas are below the 50% level, known as the discount zone. While this FVG is above the 50% level, the premium side of the range. Hence, we're only interested in buys in the discount zone due to several reasons. Typically, the market targets early buyers. So, a more conservative approach to entering long trades is to wait for the price to enter the discount zone. This increases the chance of success and reduces the chance of falling victim to a liquidity grab. In the bearish scenario, we have two fair value gap areas. The idea is to wait for the price to pull back to these zones and enter short trades. However, applying the Fibonacci retracement tool reveals that one area is located in the premium, and the other in the discount. As mentioned earlier, we're only interested in selling in the premium side of the range. So, this becomes a solid area to look for short setups, resulting in a more conservative approach to entering trades and a higher risk-to-reward ratio. It works best when the market makes deep retracements. However, during aggressive trends, selling on the discount side of the range can also be profitable. The key point here is that you won't win every trade. Even with a 30% win rate, you can be profitable as long as you have a solid risk management plan. You can't control the outcome of a single trade, but you can control the outcome of an overall good risk management plan. As long as you take high-quality setups and adhere to your rules, you'll be fine. You don't need to win every trade to become immune to losses. Now, with that said, let's continue with the second part of this video. This trading plan comprises two major time frames. Firstly, we analyze the higher time frame for general analysis, including market structure, direction, key levels, liquidity areas, and fair value gaps. Secondly, we zoom into the lower time frame for confirmation and trade execution. Remember, this trading plan isn't restricted to specific charts or time frames. However, your entry time frame must be 2 times lower than your higher time frame. Here are 3 timeframe combinations for applying this trading strategy based on your style. For instance, if your higher timeframe is the 4-hour chart, you zoom into 15 minutes for trade execution. We've simplified this trading plan into 2 major steps. Let's start with the first step, analyzing the market structure in the higher timeframe. In this general analysis, we apply smart money market structure concepts to identify market direction and key levels. To identify the direction, we observe structure breaks, character changes, and reversal liquidity sweep patterns on the chart. For instance, on the candlestick chart, we see multiple upside structure breaks, indicating a bullish direction. Then, a reversal liquidity sweep pattern above the previous high suggests a potential reversal. This reversal is confirmed with a break and close below the low, indicating a change of character where buyers fail to push prices higher and sellers take control. In a bullish scenario, the change of character occurs when prices trade below the lowest point of 2 consecutive highs, signaling a likely reversal, particularly in a long-term uptrend. If the market direction isn't clear in a specific time frame, it's better to move on to the next pair to avoid uninformed trading decisions, focusing on clearer trends for better decision-making and risk management. The next step in the higher time frame analysis is identifying key levels. We do this to identify liquidity areas and potential reversal points, our higher timeframe targets. We consider traditional support and resistance levels as liquidity areas, especially equal highs and lows or multiple rejections, which are critical liquidity zones. Identifying liquidity areas is crucial because they influence price movements. The market tends to move towards levels containing liquidity and away from recently liquidity-swept levels. Thus, grabbing liquidity before reaching an optimal trading area confirms price movements we expect in the market. These key areas may also significantly reject prices, so we secure profits before reaching them and ensure a reasonable risk-to-reward ratio before entering trades. The final step in analyzing the market structure in the higher time frame is identifying fair value gaps, our trading zones. After identifying FVG zones, we use Fibonacci retracement levels to locate the zone. If bullish, we're interested in FVGs located in the discount zone, and if bearish, in FVGs on the premium side of the range. After identifying our optimal trading zone, we wait for the price to tap into that area and zoom into a lower timeframe to search for reversal confirmations and execute trades. This concludes the general analysis. These are the concepts we apply in the higher timeframe. The second step of this trading plan is to look for confirmations and execute trades in the lower timeframe. After waiting for the price to enter our trading zone, we need confirmation indicating the short-term downtrend is over and the price can move upwards. To identify this reversal, we observe liquidity sweep patterns and changes in character. A valid liquidity sweep below a low signals a possible reversal, while a price break above a high indicates a valid change of character. After confirmation, here's how we execute the trading setup. We wait for price to create fair value gaps. Although the lower timeframe gap needn't be inside the higher timeframe gap area, after identifying FVG areas in the lower timeframe, we set a buy limit at the start of the FVG zone and place our stop below it. For the first target, we make our trade break even by closing half our position when the price reaches our 1 to 2 target. The next target is the first important zone in front of the price in the higher timeframe. Before exploring real chart examples, let's discuss common scenarios on the chart and how to handle them. In a scenario with a very tiny fair value gap area, Consider a large zone as your stop loss to protect against market fluctuations. In the contrary scenario, with a large FVG zone in the lower timeframe, either set a smaller zone below the FVG area as your stop or place your buy order in the middle of the zone. This significantly improves your risk-to-reward ratio in case of a winning trade. These are the concepts we apply in the lower timeframe. Now, let's examine real chart examples. On the Euro-Dollar 1-hour chart, a downtrend shifted with a liquidity sweep pattern and change of character, indicating a bullish direction. We identified two fair value gap areas, with only one on the premium side considered a potential trading area. After the price entered our FVG area, we zoomed into a lower time frame for trading opportunities. On the 5-minute chart, a change of character confirmed a reversal, and a new FVG area appeared, where we placed a buy order at the start of the zone and our stop below it. Our long-term target was the next important zone in front of the price. Now, looking at the gold 1-hour chart, we see a downtrend with two fair value gap areas, but only one is valid for trading. After the price returned to this area, we zoomed into a lower time frame for trade execution. On the 5-minute chart, a change of character and an FVG area appeared, prompting us to place a sell order at the start of the zone with a stop above it. As seen, we experience losing trades despite a well-thought-out trading plan. The key is to adhere to your rules and follow a risk management plan. With consistent application, you'll navigate through both winning and losing trades effectively. Our video has also ended. If you found it valuable, please like and subscribe to our channel. See you in the next episode.